people usually think that just making timely payments is enough to maintain a good credit score. But that's only part of the story. In fact, your payment history makes up just 35% of your credit score. The rest involves other factors that many overlook, like credit utilization, length of credit history, and more. Luckily, understanding all the factors and managing them effectively can significantly improve your score. And today, I'll show you how. Before the modern credit system, lenders had to personally know their borrowers or rely on trusted recommendations to decide if they were reliable. As credit became big business, this method was no longer practical. So, financial companies developed mathematical models to assess a borrower's risk based on their credit history. In 1989, they introduced the first industry standard algorithm, the FICO score. This formula was quickly adopted by the big three credit reporting agencies, Equifax, Experian, and TransUnion. Your FICO score is a three-digit number between 300 and 850 that indicates how safe it is for a lender to give you a loan. A high score suggests you'll likely repay the money on time, making lenders more inclined to offer you favorable loan terms. Conversely, a low score indicates a higher risk, leading lenders to charge more interest or deny credit altogether. Every time you borrow or repay money, such as using a credit card or making a student loan payment, the lender reports this activity to the credit bureau, where it impacts your score. Let's break down the 5 main components and their respective weights. First up is payment history, which accounts for 35% of your credit score. This is the most significant factor. It looks at whether you've paid your bills on time. Consistently making on-time payments boosts your score, while late payments can significantly hurt it. Severe delinquencies like defaults, bankruptcies, and foreclosures can have a long-lasting negative impact. So, even a single missed payment can hurt your score, but the impact lessens over time as long as you don't miss additional payments. Next is credit utilization, which makes up 30% of your score. This measures how much of your available credit you're using. High balances relative to your credit limit can lower your score. Aim to keep your credit utilization below 30%, but ideally under 25%. Paying down balances can really help improve your score. The length of your credit history accounts for 15% of your score. This includes the average age of all your accounts, the age of your oldest account, and the age of your newest account. Maintaining older accounts open, even if you don't use them frequently, can positively impact your score. Credit mix accounts for 10% of your score. This refers to the variety of credit types you have, including revolving credit like credit cards, installment loans like student or car loans, and mortgages. Having a diverse mix of credit types can boost your score, but only take on debt that you need and can manage responsibly. Finally, new lines of credit make up 10% of your score. This looks at your recent credit activity, including the number of new accounts you've opened and hard inquiries from lenders checking your credit. Avoid applying for several credit accounts in a short period. However, if you're rate shopping for a mortgage or auto loan, multiple inquiries within a short window are usually counted as a single inquiry. It's also important to note the difference between hard and soft pulls on your credit. Hard pulls, done by potential creditors, can affect your score, while soft pulls, such as those by insurance companies or employers, do not. Understanding your credit score and how it's calculated can help you take control of your financial future. Remember, your score is just a reflection of your past relationship with debt, not a measure of your worth or financial responsibility. If you found this video helpful, don't forget to give it a thumbs up and subscribe to our channel for more tips on managing your money. Thanks for watching, and see you next time.